Hi, you're watching Investor Insights. I'm Vic, and barely after 2 days that I've uploaded TAPER Talk, the Fed's Quandary, the Nonfarm Payrolls came out in the US, and the results are, as I've always said, dismal. It doesn't matter with this particular print which way you look at it. There is no positives. Oh, sorry. The only positive is that the number is actually positive and you don't have actual job losses overall. But as usual, you have to look beneath the surface. And in this case, you've got a bad number, and beneath the surface is an even worse number. Now, you're looking at an employment print of 74,000 jobs added in the month of December. I've put up the actual data in the description box below, and you can have a read of it. And almost 3/4 down the way down, it will tell you that 40,000 of those 74,000 jobs, so more than half of all the new jobs created in the month of December were just temporary jobs. So waiting at restaurants, leisure services, part-time leisure or hospitality, you name it, jobs that have no long-term prospects. Still, a job is a job, and it's still an income, but eventually you're looking at a situation where you could be cut at any instant. So where does that actually lead us? Well, the job situation is the biggest gauge into the health of an economy. Without jobs, people don't have income, obviously, and without income, they just can't consume. And essentially, because GDP is a focus on consumer consumption, albeit debt financed, you're looking at a potential future GDP print that's not going to be as rosy as what the commentators have pictured it to be. Now, straight away, the commentators have come out and said, oh look, it's because of the Arctic winter conditions and so forth, but that just happened in the past 2 weeks, and we're halfway through January. So how did that impact the actual US December payrolls? God knows. But then again, everybody has to put a positive spin on things. Now, when within the first few moments of the GDP print came out, the market tanked, but it recovered, and in fact, it actually closed up to yet another new high. Why do you think that happened? Well, essentially, what I said in the last video is coming to the fore, and it wasn't just a forecast, just a personal prediction. It is more, as always, what I've said before, the effects of the stimulus. If the data is bad, then the taper for first things is not going to happen. If the taper is not going to happen, then therefore the whole quantitative easing process just continues unabated, and you have an increase in the balance sheet and a whole load of new money that's coming onto the market and fueling all these asset bubbles. So you're looking at another rise in the stock market, rise in the housing market, and a recovery in the bond market. I saw the 10-year basically lose almost 20 basis points upon the release of the data, because as I've said before, it just signifies that the Fed is just going to keep on buying these bonds and keep rates down. Now, this actually reinforces the message that I was giving in the previous video. I'm not going to go through it. it actually went for too long, I'm sorry. Where the Fed is essentially signaling to the world that it is responsible. It has to give the impression that it is giving responsible monetary policy and trying to clamp down on inflation. Print money, that's not going to happen. Trying to clamp down on inflation and try and work itself out of debt. Well, as I said, the whole process doesn't make any sense, because the Fed is actually trying to inflate itself out of debt. And as I've always stated before, when you're going to start to issue $100 trillion notes, you will get $83 trillion change from a single note from all your debt holders when the time comes, if that time comes, if those debt holders are dumb enough to let you play that game for too much longer. But essentially, the Fed, in their last statement, has managed to give the world the impression that it was doing the right thing by tightening, that is, having less aggressive monetary policy through the tapering of the asset purchases, which was data dependent. But that was merely an excuse to change the language of their monetary policy of stopping this emergency Fed's funds rate of 0% when unemployment hit 6.5%. And just on that note, unemployment actually hit 6.7%, which is the lowest in basically these 5-6 years. But beneath the surface is a really, really ugly number, in that if you look at the unstated unemployment number, which I've always spoken before, I actually have put up this number, this article, in the description box below, so you can have a perusal at it. You're looking at a U6 number when combined with the actual stated unemployment to be well over 13%. So you're looking at real unemployment being almost double that of stated unemployment. Now that U6 number is the number of people that have stopped looking for work, their unemployment benefits have run out, and they've given up. Now, in my book, a person who wants work and stopped looking because they're so discouraged from the lack of jobs available should be stated as part of real unemployment, because that's what it is. It doesn't matter which way you look at it, the person doesn't have a job and wants one, that person is unemployed. But if the government included them into the equation, then you're looking at an economy which is beyond teetering on the brink, because it is, and it's purely being sustained by all this debt-financed government consumption. I have to use that word now, government consumption, because the consumers tapped out. The December retail sales were the worst number, was the worst number in 4 years. So essentially, the consumer is almost non-existent. And the recent GDP, the balance of trade, was the lowest deficit in several years, but the government claims that as consumer demand increases over the 2014, that balance of trade, again, the gap is going to widen. A little note on the word trade gap, as in that 35 billion. As I always said, a gap is meant to be small. 35 billion or more, as they expect it to be. They've been averaging about 40 billion. It should actually be called the trade chasm, because that's what it is. It doesn't matter which what entity you're talking about. 40 billion to a state, a company, a country is a huge deficit. And when that number is actually a monthly debt load, you're very soon spiraling into oblivion. So, as I've said before, the Fed, in one fell swoop last month, managed to con the world into believing that it is tightening, but at the same time it was actually loosening. So by stating that we're gonna taper our asset purchases, but realistically all they did was say that monetary policy was going to be looser beyond unemployment going below 6.5%. And the fact that this data, this non-farm payrolls data for December, is going to give the Fed more scope to delay this taper for several months until they get a better print. And so they will just keep on printing and printing and printing, and money that is, and buying more and more of these bonds to the tune of 85 billion a month. I also stated in the previous video that these assets will have to be purchased in greater amounts, simply because as the debt load increases, it is harder and harder and harder to keep interest rates down unless you purchase more bonds. This is purely a mathematical analysis. There is no subjectivity to it. If you owe more and more and more and more money and the interest accrues, you have to earn more and more money or make more and more money to pay it off, to just be able to sustain those debt levels. You cannot there is no way that you can repay any debt if the interest accrued is beyond the scope of your income, and that's where America is staring at right now. As interest rates rise, you're going to have a whole lot of issues with government debt and corporate debt and the whole works. Just a little correction from the last video. I stated that a bond was an IOU issued by a sovereign state. Unfortunately, everything is shot in one take, basically in one breath, unrehearsed, so it was a boo-boo. What I meant to say was a treasury was an IOU issued by a sovereign state. My apologies. Now, as this debt keeps on growing and the country actually is, as I said, totally unproductive, you have a situation where there's just no means by which America can get itself out of this situation. The stimulus is actually stifling growth, real economic growth, because the money doesn't find itself into productive ventures. The government is preventing productive ventures from sprouting, from flourishing, because through fiscal policy that is so stupid, the money finds its way through the path of least resistance to actually fuel these asset bubbles. It's just like a river. It doesn't run upstream, it runs downstream. And when you have so much loose money, free money flowing around, it just finds its way into stock market, housing market, and bond markets. It just does. Look at Britain. It can be shown that the QE per capita is greater than that of the US. And what's just happened there? We've got London housing has reached the highest level in terms of price of all time. It's the highest real estate property prices of all time over in the UK. And there was an article recently, I'll see if I can find it and put it in the description box, where on December 29th there was a rush to get approvals to actually build subterranean extensions because as of the 1st of this year, the local councils were gonna not approve them anymore. So people can't even buy land to build houses on. So instead, the only way to go is down. They can't add upwards. So therefore, they might as well dig. Now imagine a society living like moles now because real estate is so expensive. But that's the subject of another video. So The main message that comes in this video is that the Fed will never taper, and if it does, it's going to be retracted instantly. The whole mention of taper is merely a token gesture to give the impression to the markets and to the debt holders that the Federal Reserve and the policymakers are trying to decrease the debt burden. But that in itself will never ever happen. Debt begets more debt as the interest accrues more interest. On that note, the Federal Reserve has a $4 trillion balance sheet. That in itself earns a truckload of supposed interest, which obviously, like all the other debt holders, it doesn't get. All it gets is more IOUs. So therefore, the actual balance sheet is not growing at $85 billion a month. It is growing at $85 billion a month, plus several billion that it gets in interest for all the treasuries that are maturing or are being rolled over every other day. So already the perception that the Fed is only buying 85 billion a month is an absolute fallacy. It is buying almost 100 billion a month. You can say reinvest. And the time is nearing when the economy and the data cannot support the Fed statement that everything is recovering soundly and they will start tapering. In fact, the opposite's going to happen. They have to increase the purchases even further. I'm talking over 100, 120, 150 billion a month just to get the economy going. Just going. Forget growth, just going. So just a quick example, the American economy is just like this Eastern European weightlifter. I'm not using that as a real stereotype, but if you watch the Olympics, you get the drift. But this Olympic weightlifter that's addicted to steroids, and the economy is just this growth is supposed to be this huge weight that this guy's got to lift, but the weight's getting bigger and bigger, and you've just, to progress forward, the debt is basically adding more and more weight to the barbell, and without more and more steroids, this guy can't lift it. So essentially, if you decrease the amount of steroids, not only can this guy not lift it, but he's going to break something trying to in an attempt to lift this weight. So they need more stimulus. And one Fed official, I've put the article in the description box. I can't pronounce his name, I'm sorry, my English isn't that good. But this Fed official claims that Fed monetary policy is not loose enough. Yeah, Jesus. Fed funds rate at 0 is not loose enough. So basically, have negative rates, as in hand money out, for people who want, as in hand money out, have negative interest rates, or as he's suggesting, the Fed has to do what I said they always will head towards, and that is increase asset purchases. Absolute joke, absolute farce. But unfortunately, the debt holders are happy with that, and investors are still pushing up this S&P. It's just all a gigantic, what I call a manic hyperbolic expansion phase now. More on that on another video. But investing, more speculating within any of those three asset classes, whether it be real estate, stock market or bond markets, is going to be a suicidal trade, even more so this time around than it was in 2007, 2008, even more so than in tech wreck 2000, and 3 times more than in 1987. Good luck to you folks if you want to speculate, because the upside may be there or thereabouts, but the downside is huge. You are looking now at a cataclysmic drop in all those mentioned markets. The timing, I'm not that smart, but the signs are there. So if you can read beyond the surface, if you can look beyond the surface of the Federal Reserve statement last month, and if you combine that with the December retail sales print, and you look at the actual GDP print, which was mainly inventory building by companies that stocked up or built stuff in anticipation of decent Christmas sales, which the previous statement says it didn't happen, coupled also with this non-farm payrolls print, is clearly signifying, well, to me anyway, that the economy is in a very, very bad shape. And this black hole of financial annihilation is looming, and they have passed the point of no return.